Okay, today we are going to talk about introduction to financial statements and financial statement analysis. So in finance, we collect historical data from financial statements. And for public companies, they are required to file both annual and quarterly financial statements with the SEC. And you can find their financial statements online through SEC website or through the company's website. And there are four, I would mainly discuss three financial statements. The balance sheet, which shows the mixture of assets and claims to the assets, that is debt and equity. Income statement, which is also called profit and loss, P&L. It shows revenue all the way down to net income. And then statement of cash flows. There are three categories. We will look at operating, investing, and financing activities of the company. So the annual report typically is very long. I would highly encourage you to review maybe a dozen annual reports from some well-known companies. Sometimes the company may include a letter to shareholders. For example, Warren Buffett, his letter to shareholders is widely circulated in the investment industry. Or Jeff Bezos from Amazon, his letter is well crafted, it's very good. And beyond the descriptives and the colors, there are numbers. So the numbers included in the annual reports, typically we can extract and analyze the company's situation. So there are three main types. The balance sheet provides a snapshot, so it's at a point in time. The income statement is over a period of time, whereas statement of retained earnings and statement of cash flows have similar properties because they are summarized over a period of time. So let's take a look at a balance sheet. Balance sheet, so we start with assets. So here's a typical balance sheet. We have assets and then claims to the assets, the claims. So basically we have debt holders and equity holders. So this claim the company's asset. So for assets, in US, we typically report based on its liquidity. So this liquidity increases here. Okay, liquidity. So what is the liquidity? That is how easy it is to convert into cash. Cash is already cash, so that you don't need to convert, and it's the most liquid. And account receivable, you are going to receive pretty soon, so it's right after cash. But if you have short-term investments, it could be here as well. And it takes time to liquidate your inventory, so it's not as liquid. And these three these are together termed as current assets.
Sure. Are we?
And then we have gross fixed assets, less depreciation. Then we have net fixed assets. The fixed assets are generally related to plants, equipment, and properties. And these are not easy to liquidate, to sell off. So they are not as liquid, and we call it a fixed asset. The sum of the current assets with fixed assets give us the total assets.
I have a question.
Okay.
Is it just you and me in this class currently?
Yes.
Okay. I was on the I was in the bathroom. Actually, I wasn't really here yet.
Okay.
So, sorry to kind of stop you there. But I'm just kind of coming into this, and since I'm the only one here, I was kind of figuring, maybe you could kind of catch me up to speed where you're at here currently.
So we are discussing the financial statements and financial statement analysis. Mainly, we are looking at these two chapters, looking at where to find the financial statements and how to analyze financial statements. So that's where we are right now.
Okay.
And the recordings will be made available to all students in the class.
Sorry, my bad.
Okay. So do you have more questions?
No, my bad.
Okay. So let's continue. So look at the balance sheet. A balance sheet has two categories: the current assets versus fixed assets. And on the right-hand side, balance sheet has liabilities and equity. So the liabilities include short-term, that is what we call current liabilities, and long-term in terms of debt. And anything else is what we call equity. So the equity has common stock, retained earnings, all of this belong to equity holders. And the sum of liabilities with equity, that's what we call the total liabilities and equity. And the reason we call it a balance sheet is because these numbers has to balance with assets. It must be equal to assets. Okay. So if you look at here, so the number should match. Okay. That's why we call it a balance sheet. And the income statement starts with the revenue. So there are a lot of names for sales. So you look at the definition for each company. It may be called a revenue, maybe called a sales. Sometimes it's called net sales. Sometimes net revenue. So there are subtle differences in these terms. But in general, this is what we refer to as top line, the first line. Okay, and this is what we refer to a bottom line. Okay. So bottom line is earnings. Okay, it's also called earnings. And from revenue, you subtract all expenses, you reach net income. And these are different categories. And these are important terms. Okay, important terms. EBITDA, earnings before interest and tax, and depreciation and amortization. So it's an acronym you should be familiar with. This measures the gross margin mainly before any financial capital structure and before any tax effects. So just look at the business, how it is doing. Just subtract sales with cost of goods sold, selling, general, and administrative costs. And then subtract the depreciation and amortization, you'll reach EBIT. That's earnings before interest and tax. This is also called the operating earnings. Operating earnings, okay? And then you subtract the interest expense, you get a pre-tax income. Minus tax, you get a net income. So I would encourage you to reconstruct these numbers in Excel, and starting from this line, each of these here underlines mean below it is a subtotal item. Okay. So for now, just take a look at the format of the income statement and balance sheet. Just be very familiar with this. And then we have other data for a public company. Yes.
What did the DA mean in the first underneath COGS and other expenses? What did the DA mean at the end of that one?
Yeah, that's a good question. So if you have taken accounting classes, you would know that D stands for depreciation and A stands for amortization. So these are like if you have equipment or house or property, they lose value over time. So that's a depreciation. Okay. That's a good question. And for public companies, typically you'll find the number of shares for the company. And if you know the number of shares, if you know the stock price, these two multiply together, you get the market value of the company. So the market value for this company is just $225,000. So if these are in thousands, then you get 2 million. Okay, so it depends. Be sure you look at the units. Okay, the unit is important. And here you look at here, what happened year over year. The earnings declined, right? The earnings declined, dividend declined, and stock price dropped dramatically. So this three, so it's a bad year. It's a bad year. So why is it so? We want to find out why it is a bad year. And we further look at the retained earnings because you had a loss that reduced your retained earnings. So your retained earnings reduced dramatically from 200 to 32. So let's take a look at, since I mentioned it's a bad year, so why is it so? So first thing on the cash flows, you see you had a loss. So that's bad. Okay, so that's a bad year. And so if for a good company, they should have a profit. Okay, and if you are having losses and losses and losses, you cannot continue forever to have losses, and then the company will go bankruptcy or the company will close its doors, right? And the goal of the company is to make money, right? So increase shareholder wealth. So this is bad. And the depreciation, and these are related to working capital. This is what we call working capital. So we'll look at this working capital later as well. Okay, and all these categories, okay, all these categories. And this is what we call adjustment to the working capital. And here we look at the net cash provided by operating activities. So the operating activity did not bring in any money, and instead it consumes money. So that's bad news. So this is bad news. Okay, this is bad news. And then we look at the investments. So investing, so the company looks like it increased its fixed assets. So maybe the company expanded. So if this is negative, that's expansion. Okay. So the company is expanding its business, and the expansion is not profitable at this moment. Okay. And here, so the company expanded. So how did the company finance the expansion? So part of that is financed by short-term debt, and half of that is financed by long-term debt. So it's financed by debt. Is there any financing by equity or stock? No. So it's solely financed by debt. Okay. So the company borrowed money to purchase fixed assets. And the net change in cash is negative. So the company cash balance declined. So what can we conclude about this company's position, financial position, from this statement of cash flows? So essentially, the company is not doing well. So the net cash is negative from operations. so it's not good. And that's really mainly driven by negative net income. So NI is net income. And the company borrowed money to meet its cash requirements and also to expand its business. So this could be good or bad. So in a sense, if the company is expanding, so that means the company probably, it's increasing its revenue. And after that borrowing, the cash account still declined. Okay. So overall, we see that it's not a pretty picture for this company. So unless the company can turn around to be profitable again, otherwise it's bad news. So this expansion create any additional net operating profit after tax. So we will term this as a NOPAT. NOPAT, okay. And it's called a net operating profit after tax. Taking the first letter from each of these. So let's look at how we calculate this and see if this is positive. If it's positive, it's a good news. Yes.
On the quizzes or exams, will you be using these shortened terms, or will you have it like written out?
Because yes. On the so the short acronyms will be used all over the places because these are essential terms in finance, so it will be used.
I was just wondering because like in all the accounting firms I've worked with, they haven't really shortened it to like NOPAT and whatnot. They just say net operating profit after taxes. I was wondering.
Yes, this definitely you'll see this in various places for sure, because these are very important terms. NOPAT, for example, net income. So yes.
Okay.
Hopefully you are not going to have too many. Altogether, you are not going to have over 100 of these. So if you count, it's not that many. But once you started to dive into this, you get to know more with the terms better and better. Then it becomes just normal to you.
And also, when we're going through, especially in these next two quizzes or whatever, I haven't had the time to go through the chapters yet. I'll be doing that today. But when we're going through the quizzes today and in the future, will we be focusing more on the calculations of like the actual like income statement and the balance sheet, or more like the terminology behind it, like just knowing?
You are going to have both terminology and calculations, so everything will be there. So one of the chapters probably you have more terminology, but the other has a lot of calculations. So in finance, so we cannot avoid these calculations, and the terminology is very important as well. So this is I know it's a lot, and it just takes time to really get familiar with these concepts and calculations. But it's a good question, and the answer is yes. We are going to have both types. Okay, so but don't panic. Don't panic. So I think the strategy is first you have to read the book. If you don't read the book, then you don't have a foundation, right? So you have to build a good foundation to read the book, and then maybe watch the lecture video. And I try to make the video short. I don't want to record too long. So like the video I'm recording now, I don't want to spend like hours and hours on it, so that that wastes your time and my time. So I reduce my I try to be concise. Okay. So let's continue. So if this NOPAT is a positive, then it's good news for the company. But we need to know how to calculate this number. So how is this number calculated? So it's calculated as EBIT 1 minus tax rate. So EBIT is earnings before interest and tax. And that usually you can find it on the income statement. So tax rate, you can just divide the tax by the pre-tax earnings. You find out the tax rate. And then we got this 2012, this NOPAT is negative. So it is a big decline. And so it turned from positive to negative. So this is a bad news. So the company is not doing well. So what effect did the expansion have on net operating capital? The company here is a manufacturing company, and it has inventories. So once it's sold to customers, then it's going to have account receivables. So if the company has to build a lot of inventories, that consumes cash. If the company offers customers credit, hey, you buy our product, you pay us back in 50 years. Hey, well, I'll just buy from you, right? So you just cannot have that loose, credit policy for the customer, and so that consumes your cash, right? Because it's kind of you lend your money out. And another side is your suppliers. You want to pay your suppliers as late as possible. So to save cash. So apparently cash is very important in running the business. So we'll look at the net operating working capital. It's the operating current asset minus the operating current liabilities. So non-interest bearing means this exclude short-term debt. So short-term debt is not part of the working capital. And we just picked these items from the balance sheet. Okay, these items are from the balance sheet. So cash, account receivable, and inventory. And here is, let's see, from your balance sheet, if we take a look here. And so here would be the account payable, and this is excluded because this is a debt, and this accrual will be there. So 524489. If we look at here, so that's 524489. So be sure you know where this data is from. This data is from financial statements, and specifically in this case it's from the balance sheet. And we see the net operating working capital, there's an increase. So if this increased, that means your cash, you stuck more cash there, so that reduce your cash holdings. So this is and in general, if you are expanding your business, this will increase. So we could not just make a judgment say this is good or bad, because if you are expanding the business, so the increase might be just a natural result of the expansion. So what did the expansion have on total operating capital? Then we need to understand what is operating capital. And I would say, this chapter is financial statements and financial statement analysis. It's really a review. It should be a review of what's covered in accounting. But I'll try my best to introduce this concept if you didn't learn much in the accounting class. Okay, so if you do learn a lot from the accounting class, then you may just skip the video altogether. But if you did not, I hope you just pay attention to what I discuss. So what is operating capital? Operating capital has two components. One is the working capital, one is the long-term long term. Okay, so these two sum together, that's what we call the total operating capital. And you see the operating capital increased. So increase, that's a huge increase, right? That's a big increase there. So from 1.1 to 1.8 million. So that's a huge increase. Let me get to my pen. So that's a huge increase. Let me see, where's my pen? Okay, so big increase. And the net investment in operating capital is a difference between these two. The difference. So the difference between these two is a net investment. So if we invest in this much, we better make a return. Hopefully, with the net investment in operating capital, we have additional returns, additional profit to justify this investment. So let's take a look. So what's our assessment of the expansion's effect on the operations? We see the sales increased, that's good news. However, you are expanding at a loss. So that's bad news. And it does consume your capital. So that's slightly negative there. And you are having more capital invested. And the net income is negative. So overall, I think the company maybe just trying to, grab more market share. And in that process, that company is doing that at a loss. So then we need to look at the management discussions to really understand whether this is a good strategy or not. Yes.
Okay, so when so your net operating sorry, I gotta look. Net operating profit after taxes there is a negative. Does that mean that like the cost of goods sold and everything else outweigh the sales, or is that why you're growing at a negative? Or like why are you growing at a negative there on that one?
Why are you growing at a negative?
I mean, shouldn't is that including like paying off the debts for borrowing the money and stuff? Is that possibly the reason why you'd be growing at a negative too, or on the
Well,
NOPAT?
you are growing at a loss, and at this moment we don't know if the company it might be because of the competition, so that the company increased its investment in capital, and then hopefully later on the company can turn a profit. So at this moment we really don't know, but here we do know for sure is the company invested capital, and that return is negative in terms of net income.
But okay, and so we should so 2013 would be the year that we would actually see like a return on investment there, or is that not the case? Well, 2013.
So the question is, are we going to see a positive news in 2013?
Yes.
Or 14 or 15? So I would say this: companies fail. They may never come back. They may just die. Okay, so the investment, if you look at in Jonesboro, Arkansas, there are how many restaurants are there? Almost every year I saw several businesses just went bankrupt and just closed their doors. So that's just that's just business. So we would hope, if we are the financial manager of the company, we would hope we are going to do better in 2013. But can we do it?
I was just wondering because I mean I don't know. I just saw the sales increase so drastically. The fact that its net income is much lower is just incredible to me, especially after investing so much with your operating capital. I
So
mean,
that's a concern, right? So that's a
yeah.
concern. You can
Okay.
easily increase your sales. Say I own a restaurant in Jonesboro. I just need to buy another restaurant to double my sales. If I buy 3, I'll triple my sales. So what? If I pay, $5 million to buy just a small restaurant, and I'm really at a loss. So increasing your sales, that's not the right way, right? So you cannot grow your sales at all cost. But it's really a strategy. So as a company's manager, you need to really think about, how fast we should grow.
Yeah, so this would be a case in where your 2011 staying at that would have been much better than making that huge investment, I guess. Because I mean, if you're growing at 114,000, anyways.
So the point is the company doubled the sales at a loss. That's why if you look at mergers and acquisitions, most merger acquisitions don't work out well. But as the company grows bigger, the chief executives do get paid more. So there's a conflict of interest there. They want the company to be bigger because they get paid more. But hey, who cares if it's loss or not, right? But investors, shareholders, we care about it. Yeah, good questions. Good questions. So what effect does it have on cash flows? I would bet, if will have negative impacts on the cash flows because you didn't bring any profit in. So the net cash flow is negative relative to the positive one. So that's bad news. And the operating cash flows reduced dramatically. So what is free cash flow? Free cash flow is a very important concept in finance, free cash flow. So we need to, so I would encourage you, everyone, to do this calculation, for both 2012, 2011, or just find a company and do these calculations. The free cash flow is related to the cash flow available for shareholders. So if you are an investor, if you are a shareholder of the company, that's the metric you should care about. So if it's positive, it's good. The bigger, the better. If it's increasing, it's better. If it's decreasing, it's bad. If it's negative, it's even worse. If you look at here, so it's a negative number here. And not only negative, but also not only negative, but also decline from 2011. So the point is, if this is as we discussed, if this is just temporary for 2012, it's okay. If for 2013 you started back up, growing at a profit, then it's good. So negative free cash flows, it's not always a bad sign. It's not always, but mostly it's a bad sign. Economic value added is looking at the difference between your NOPAT and your cost of capital in terms of dollars. So the company should strive to generate positive EVAs. So here's another term. So in this chapter, you probably see a dozen terms, a dozen abbreviations. And if you have not seen this in accounting, this is a place you should, start to just take out a page, and I believe you can fit everything in just one page. Yes.
Sorry to keep taking up your time. And in the last slide there, when we're looking at the equation, the tax rate, how do you get that? Was it given, or did you calculate it somehow?
Yeah, tax rate can be calculated. So before tax, if it's you earn $1,000, if you pay the $100 tax, just use $100 divided by $1,000, you get 10%. So that's a tax rate.
Okay.
So it can be calculated from the income statement. So what is the firm's EVA? And here you can see that EVA is negative, so it's not good. So practice these calculations, okay? And this expansion increase the company's market value added, MVA. So that's related to the market capital or the share price. So market value added is market value equity minus equity capital supplied. Here, because the stock price declined dramatically, so that definitely drive this MVA to negative. So did the company pay suppliers on time? So where can we get this information? This is from the account payables. So if your account payable was $1 million, now it's zero, that means you already paid your suppliers, right? So you paid on time. However, if your account payable it was $1 million, now it's 10 million, hey, you just kind of accumulated, delayed your payment to suppliers. So if there's a big increase in account payable, then so the company will be, I would think it's suspicious. So here, probably not, because the account payable just increased dramatically. So this is bad news. So is the company selling at a profit? That means the sales price is higher than cost. So if the company sells, occasionally you'll see this in Aldi or in Walmart. Some items are really, really, it's very cheap. You would think, how do they cover the cost? They are indeed selling at a loss to attract more customers. But they cannot sell everything under the cost. Then they'll close the door very soon, right? So it's a strategy. Overall, you should have your sales price higher than the cost. And there we see it's the answer is no, and it's a negative. So what if the company sales manager decided to offer 60-day credit terms to customers rather than 30-day credit terms? Is that a good news or bad news? So first of all, if you make it extreme from 30-day credit terms, let's say to 300 years, well, they never pay you back, right? So you get more and more customers. But then you will have your cash balance reduced. So that's not good news. So it depends on your strategy. If you are trying to get more customers, it's good. But if you are trying to shore up your cash, it's bad. So your account receivables will increase, cash will decline. So it depends on your competitors' actions as well. So how did the company finance its expansion? So it's financed mainly by short-term debt and long-term debt, the mixture, as we look at it from the statement of cash flows. And also, if you look at a balance sheet, you can see the year-over-year change, in the increase in debt. So the company issued a long-term debt that reduced the company's financial strength and flexibility. The company also issued a short-term debt. So what would this company have required? Would this company require any external capital if they broke even? Well, it's part of the net income, broke even. If the company even break even, the company still double the asset, huge increase in assets. That marginally help, but will not reduce much of the external financing required. If we take a look, yes, the company would still have to finance. It's just like you have a restaurant, you buy another restaurant. If you just break even, but you still have to borrow to buy the other restaurant, right? Because you cannot just use the profit or whatever to buy the other restaurant, because that's not enough. What happens if the company depreciates fixed assets over 7 years relative to 10 years? So the depreciation is a tax shield. Okay, you pay lower tax, but it's not going to influence any physical assets. And the tax system is dynamic. It's not fixed, okay? Because it depends on for example, the election outcome. So the reforms, for example, in the early 1990s, the tax rate was very low, at 20% or so, and then it was increased to 30%, 40% for companies. And then in 2017 also, they had a tax cut. Do you think we are going to have a tax increase very soon? Well, I don't know. I think probably so, because if the tax receipts for the government reduced, then the government is going to run at a deficit, and you cannot run at a deficit forever. Maybe you can just borrow money from the future, maybe for the 100 years, but it's good for us, bad for the future. So it depends on whether we are selfish or not, right? So I think for me, I really like lower taxes. We would prefer to pay no tax, right? But the government need to run smoothly. Still, we need to pay at least some tax. But the point is, the tax is not static. In some older books, you see 40% tax rate, but in the newer ones, you see 25%, 21%, the new tax rate. And there are various tax treatment for this company line items. So that's what we call the tax policy. Okay, tax policy that may influence the companies, the directions. Okay. So the tax is a very complex issue, and if you are interested, I would encourage you to take a tax accounting class, and you may have a tax accounting 1, tax accounting 2. So it's not just a simple issue. So it's really beyond the scope of this class. But I do want to point out, tax is never a constant. It's ever changing. So if you get to know more about tax accounting, you can find a job as a lawyer or as a tax accountant to help out the companies. And that's pretty much this chapter. And we do have another chapter coming up. Let's see. So any more questions?
Was that chapter 2 and 3 that we just covered?
Not yet. We have chapter 3 right here.
Okay.
So here we have 31 slides, and this is really just look at ratios. Mainly we look at ratios, okay? Mainly we'll do ratio analysis. And you get familiar with the 5 major categories of ratios. And here you see more acronyms, okay? So for example, what is DuPont system? So here's a review of the balance sheet. So balance sheet, and then income statement. And what do we do with this data, right? So first of all, we want to find out, year-over-year changes. And a lot of times we use ratios because ratios standardize numbers. You see the company increased, revenue increased by, 2 million. So what? For Apple, increase of 2 million means nothing. But for my company, increase of 2 million is astronomical. So we use revenue. We use ratios to measure the changes, to standardize numbers. Like profitability, we look at, the company has earnings of 2 million, but the revenue is 2 billion. So it's really low. Whereas if you earn 2 million on 20 million revenue, that's good, right? So we need to standardize numbers. And we can use ratios to look at the strengths and weakness of the company. And we can look at the ratios over time. Over time, that's what we call the trend analysis. If we compare it to other companies, that's what we call a peer analysis. So ratios are powerful tools in financial analysis. There are 5 major categories of ratios: liquidity, efficiency or asset management, and leverage. This is what we call leverage, debt, profitability, and market value. Then we'll look at how we calculate this and make some comments. So for liquidity ratios, we generally look at the current assets. Okay. So there are at least 2 quick ratios, at least 2 liquidity ratios we need to pay attention to: the current ratio and the quick ratio. The quick ratio is just a minor change from the current ratio. So in general, if this number is higher than 1, it's better. So that means your current asset can cover your liabilities, current liabilities. So the company in this case is doing better over time. It's doing better than last year, but still not as good as the industry. So you look at this over time and relative to industry. Over time is good, but with the industry is bad. So the company still have more work to do. Yes.
Can you go back one slide for just a second? Inventories. Okay. And current liabilities. Thank you.
Okay. So the asset management ratios is also what we call the efficiency ratios. And this you have to practice quite a bit to get to know this. So let's look at also over time and relative to peers. So this is a inventory turnover, days sales outstanding, and if we look at this is the operating cycle. How long you start from your inventory to the time you receive the cash. So this is a cash in and cash out, and this is cash in. It takes in here it takes how many days? So this is 135 days. And in certain times, the company may have negative cash conversion cycles. That means the company receive cash first, like a Tesla. Hey, you pay us a deposit first before we'll make the car. Maybe we'll make the car in 5 years for you, but hey, pay us a deposit first. So let's look at a fixed asset turnover. So this asset turnover, the assets will be the denominator. So here we need to look at compare to the over time and also relative to the peers to find out. Just a ratio by itself, if you are not experienced in the industry, then it won't tell you much. For example, if I say the company's profitability is 10%, so what? 10% profitability, is that good or bad? Well, I don't know. If it's Walmart, it's good, right? Because Walmart should make the margin is low. However, if it's for Apple, it's probably bad, right? So you need to put the ratios in context. Debt management, okay? Debt management. Debt is a measure of the leverage, okay? The percent of debt. This is what we call the percent of debt. So here the company uses 44% of debt, 44% of debt. And most of US companies have 50% debt, okay, 50% debt. So 50% equity. And the equity ratio is just 1 minus debt ratio. 1 minus debt ratio is just 60% debt, 60% equity, 40% debt. So this is also another look at the balance sheet. Okay, balance sheet. So what is the equity multiplier? So equity multiplier is the total assets over equity. Okay, total assets over equity. Total assets over equity, 1/4. So the equity multiplier is 4 there. Profitability. I think this is a very important ratio because the company to survive need to be profitable. This is also called a survival ratio. If you just keep having losses, you are not going to survive. So in this case, the company's profit margin is pretty low. I think it's probably in the retail industry because it's really low. And return on asset is not too bad. Return on equity is pretty good there. And again, we need to look at these numbers over time and relative to the peers. Market ratio. Market ratio look at the market prices. So mainly look at the stock price. So this stock price over earnings, this is what we call the PE ratio. It's very important. So for SP 500, the PE ratio is usually 15 to 20. Yes.
I mean, you're saying, I know you're just talking about like how this is good, and that's not too bad of a ratio or whatever. I mean, is there industry standards? Is there a place to go for industry standards, or is that just something you learn over time, just kind of doing, or what?
So, so the question is, whether this is a good number or a bad number, or so that's a part from the experience, and a part is you can benchmark this data against others. So we need to look at the for suppose we have 20 companies you calculate similar companies, like and then you can calculate the P ratio, see which one is higher, lower, and then you'll be able to get more information. So that's what I meant, previously, this 10%, right? So this 10% didn't tell you much information. You need to put this into context. So where can you get the information? You can get it from financial statements of various companies. Suppose you are interested in dealers, Macy's, and these are public companies. You can get their financial data, and then you can make a table yourself.
Okay, so you okay,
and alternatively, you can buy service. You can buy research. Others have done research for you, and you just buy it. So either you do it yourself, or you buy the service from others. But you need more information to make an informed decision. So the point is, I think it pays off if you can calculate these numbers yourself. Okay. DuPont equation. Look at this decomposition of return on equity into profitability, efficiency, and leverage. And you could extend this into 5 terms to include tax and interest. So if you think the company, ROE is really good, so why is the return on equity so good? Is it because the company is so profitable, so efficient, or is it because the company just uses a lot of leverage? So if we look at here, the company ROE is 13%, and that's driven by part of this driven by profit margin. Okay, the profit margin is expected to increase, so that's good, right? So if you look at here, this it's good, right? Driven by market profit margins, right? So this is less than the industry, so it's not driven by efficiency. So the company is not as efficient, but the company is very profitable. And the company did not use a lot of the leverage. This is leverage. The equity divided by total assets. Assets divided by equity. So here you look at the main driver for the return on equity is from the profitability, from this number. Okay. However, if you look at this versus industry, is that good or bad? It's not good, right? Because lower than the industry. Why is it lower than the industry? Because it's not efficient enough. So with this data, then you can really see how the company may improve itself. So this data is very important, and you cannot get this data easily. You have to do some work, or either buy it, or either do some work. So that's the value of the course, and the value of doing research. Get to know the terms. So the DuPont equations really look at return on equity from different angles. So industry analysis and comparison, retail versus the computer industry. Which company is Walmart and why? So I would say this B is Walmart, low margin, highly efficient. You cannot imagine, the Walmart, if the item sit on the shelf for 2 years, Walmart is going to break, right? So not going to work. So Walmart has to turn over the things very quickly, 4 times as quickly as Intel. Okay. And there are issues with financial ratio analysis because ratio sometimes it's hard to find similar companies. Like Facebook and Twitter, are they really comparable? I don't think so. But if you don't think so, then you have to make some kind of decisions, right? So which two are comparable? So it's really not easy to find comparable companies. You have to make judgments there. And the accounting practices may influence the ratios. And sometimes it's really hard to say it's good or bad. Okay. So here we have a problem. Let's look at this problem, okay, and the solution. So here the problem is complete the balance sheet and sales that follows for this company, and so how are we going to do this one? So we need to complete this thing there, okay? So we have this information. So based on the ratios, basically we do a reverse engineering, okay? So what is debt ratio? What is debt ratio? So debt ratio is debt over assets, right? So if assets is 300,000, debt over 300,000 equal to 50%. So what's debt here?
150, right?
Okay, so supposedly to be let's say 150, right? 150,000, okay, 150K. And let's see, current ratio. So what's the current ratio? Current ratio is current assets over current liabilities. So we have a current ratio, current assets over current liabilities. And total asset turnover is the sales over total asset. So let's get this sales first. So sales, so what is sales? So this thing is called sales over total assets is equal to 1.5. If your total asset is 300, so sales will be 1.5 times this. So 450, right? So you get it one by one, and then you have the gross margin, right? 25% gross margin. So essentially, cost of goods sold is 75% of this number to get this number. So it will take a little bit time, and sometimes you get you get to calculate this number from multiple ways. Then you can double check whether your answer is right or wrong. Let's take a look at here. So here you see sales is this much, right? And from this sales, get to this cost of goods sold. Okay, and then you get to these items. Okay, so so take a look at this. If you have questions, just let me know, and I'll be happy to help you. Okay, and these calculations takes time, but the only way you get to know the financial statements in depth, you have an in-depth understanding, is through this practice and a lot of calculations. Then you will get to understand, okay, so this sales and assets, this is efficiency, okay, this is total asset turnover, and this is a profitability, okay, with sales, etc. So that's basically for these two, and next week we are going to look at time value of money, which should be the foundation of the course. And this Financial statements and financial statement analysis. In my previous courses, I usually do not cover in the course because these are really accounting related related stuff, and you're supposed to already learn this from your accounting classes. But in case you have not, you can always review what we covered today, and if you do have questions, just feel free to reach out to me. Okay.